Good day everyone, here is Treasury Management Group A, A192, and I am from Group 1. My name is Wong Wei Xiang, 254925. So let's start our presentation. So as a short introduction, in this video presentation, we are going to cover three types of financial instrument. The first one is Canada Treasury Bill, or we call it Canada T-Bill. Second one is negotiable instrument of deposit Malaysia, NID Malaysia. The third one is a sell and buyback agreement Malaysia, SBBA Malaysia. So let's start with the Canada T-Bill. So generally, what is Canada T-Bill? Canada T-Bill is actually a short-term government debt security secured by the federal government of Canada. So generally, its maturity is ranged from few months to 1 year. So we can say that the Canada T-bills is a short-term financial instrument that have a maturity shorter than 1 year. So Canada T-bill is issued at discount price, which means that is a discount basis instrument, and the government will pay back the face value when the instrument matures. So how the buyer are going to earn money from the Canada T-bill? They have two ways. They can either hold it until it matured to earn the face value, or they can sell before it's matured to earn the price difference between the buying and selling prices. So in primary market, Canada T-bill is issued via public auctions. So we are told about it later. And in secondary market, investor can sell it amongst each other. So for the purpose of creation, Canada T-bill is created to finance a government project or national debt. For example, the Canada government, they have their development project. For example, they want to build a road or university or others infrastructure that is for public welfare. When they don't have money, they can use Canada T-bill to collect funds from the public. So the Canada T-bill is actually provide a short-term liquidity to the government. So the Canada T-bill is created to be a safe, easy to understand, and highly available to public because the price of Canada T-bill is actually quite affordable to most of the average investor. So how Canada T-bill is created? First, the Canada government, when they want to issue T-bills, they will call the Bank of Canada, the central bank of the country. So they can do so because they are granted the right by the Canadian Financial Administration Act. So the Bank of Canada actually will publish the information about the incoming T-bill auction in their official website. So when the government security distributor are interested to buy T-bill from the government, they can check online from the Bank of Canada official website, so they can know the information regarding to the incoming T-bill auction. So if they are interested, they can submit bids to the Bank of Canada. After the Bank of Canada collect all the bids, they will start to compare each other. So generally, the bid with lower interest rate will pass by the Bank of Canada. So after that, the T-bill is issued to those who success. So the result of the public auction is actually will be posted by the Bank of Canada in their official website. So the parties that actually submit bids to the Bank of Canada, they can check it online. So after that, the T-bill is issued to the buyer of the T-bill. So now we are going to talk about the parties involved and their right. So here we can see that there are 4 parties involved. First one is Bank of Canada, second is Canada government, third and fourth is the government securities distributor and investor. So for Canada government, they have the right to issue T-bills because under the Canada financial law. So for the primary distributor and the investor, they can submit bids if they want to buy the T-bill to the Bank of Canada. And second, their right is they can resell the T-bill in the secondary market before it matures, and the third, or they can hold the TBO until the TBO matured to earn the face value. So now we are going to talk about the responsibility of each parties. The first, the Canada government, they have to pay the face value when the TBO matured to the holder of the TBO. For the Bank of Canada, there is actually the government agent to hold the public auction. So the third, government security distributor, or we call as primary distributor, they have to settle the bid they submit if the bid success. So second, they have to report their organization's position before auction, because the Bank of Canada have to use it to calculate their auction limit. So for the investor have sometimes they have to fulfill the minimum investment requirement set by the government security distributor. For example, the financial institution or the brokers, before they can start to invest in TBOs. And once they earn money from the TBO, they have to pay tax. For the income they earn from the TBO. So now we are going to talk about the benefit and risk of this kind of instrument. So the benefit of the TBOs for government is that the TBOs is actually a low funding cost instrument that the government can use to collect fund from public, because the interest rate is quite low. So actually the government can use it to collect fund from public without too high funding cost. For the investor, TBS is a very safe investment, because at the end of the day the government will definitely pay you back the face value, and the TBS is very liquid, which means that it can be sold in the secondary market if you need money. So actually it helps the investor to manage their finance. So for the risk, actually TBOs don't have many risks in this kind of instrument, but there are still two. First one is opportunity risk, because the TBOs actually offer a very low return to the investor. So the risk is that the investor might lose their opportunity to invest in other financial instruments that can earn them higher return. So this is the first risk. The second risk is the inflation risk, which means that because just we talk about that the TBS is actually low return. So if in that years the inflation rate go high, actually their profit that investor can earn from the TBS can easily set off by the inflation. So they might lose their money in this investment. So about the pricing mechanism, the Canada TBS is issued at a discount price, which means that this instrument is a discount basis. So it issued in denomination of 1,000, 5,000, and so on. The maximum is the 1 million, and for the minimum nominal value of Canada TBS is actually 1,000, which means that the minimum investment is 1,000. So the below are some equations that can be used to calculate the discount proceeding, the effective yield, and the interest of the TBO. So the remaining I will pass to my groupmate. Thank you.
So hi everyone, my name is Su Johan, my number is 254633. So I will continue to present about the Canada T-bill. So how is it trade? So how is this T-bill Canada is trade? The T-bill Canada is trade in two areas. In first area, in primary market, the Bank of Canada will hold public auction for the newly issued government debt instrument, including the BWBB3073. And in another area, in competitive tender, the amount of distributor can be equal to its own auction limit minus its excess net long position. The distributor auction limit will be calculated before the auction begins using their net position. So next, in secondary market, the T-bill are generally sold to the government security distributors such as bank, financial institution, or broker. And then afterward, the holder of the T-bill can resell this financial instrument in the secondary market. So in what way can we access this instrument? So in primary market, the Bank of Canada will keep updating the information related to the upcoming public auction, included the auction date, the bidding deadline, and the total amount of the newly issued T-bill and its term or maturity date. The government security distributor can make bids for their own or on behalf of their customer before the deadline. Hence, the interested investor can find this distributor to help them make a bid for the T-bills. So for the usage of this instrument in bank treasury operation, there are two usages of this instrument. The first usage is the Canada T-bill is used as financing and investing tools in bank treasury operation. And then the second one is the T-bill are also used in treasury operation as a financing tool. Okay, so for the official guideline, the public auction process for the T-bill is guided by the terms of participation in auction for government security distributor. However, Canada T-bills are also governed by and constructed in accordance to the law of provision of Ontario and Canada. So who are the regulating agencies? In this T-bill Canada, there are two regulation agencies. The first one is Canada Ministry of Finance, and then the second one is the Central Bank of Canada. So for the net instrument for our group is negotiable instrument of deposit or also known as NID Malaysia. So let's start with the definition of this NID. I do believe that this instrument is not new to the student. So NID is a bank deposit certificate given to the customer who will clarify that a certain amount of money has been deposited at a particular rate with the bank and for the certain maturity period. A certain amount of money can be in Malaysian ringgit or a foreign currency. So what is the purpose of this creation? The purpose of this instrument is to provide customer with a guarantee because the use of this certificate has a legal effect. The bank needs to return the amount to the customer at a specific interest rate and future date. And how is it created? So this NID is created back in 1979. So what are the parties involved in this NID? In this NID, there are five parties involved. The first one is insurer, and then the second one is depositor, third one investor, the fourth one another bank, and the last one is another investor. So for right of each party, as I mentioned before this slide, there are five parties. So for the first party, insurer has the right to keep all the customer personal information and right to help customer to collect the interest and maturity proceeds. And then the second one is depositor. Depositor has the right to know the interest rate and the date of maturity at the time of issuer agreement. And then the third party is investor. Investor has the right to know the interest rate and the date of maturity at the time of the depositor agreement. And then for the fourth party, another bank. Another bank has the right to know the interest rate and the date of maturity at the time of investor agreement. And then for the last party, another investor. Another investor has the right to know the interest rate and the date of maturity at the time of another bank agreement. For responsibility and obligation to each party, insurer at the maturity date, insurer the obligation to pay principal plus last interest due to the person who has the deposit certificate. For depositor, the depositor should deposit the amount as agreed by both parties at the maturity date. The depositor obligation to sell back the NID to the issuer. For investor, when the depositor sells the NID to the investor at maturity date, the investor is obligation to sell back the NID to the issuer. For another bank, when the investor sells the NID to the another bank at maturity date, another bank is obligation to sell back the NID to the issuer. And then for the last, another investor, when another bank will sell the NID to another investor at maturity date, another investor obligation to sell back the NID to the insurer. So that's all from me. So I will pass to my friend to continue the next part. Thank you.
Hi everyone, my name is Champasya matrix number 2563227. Now I will present about the benefit and risk of negotiable instrument of deposit. The benefit is each party does not need extra fee or charge when using the instrument. The second benefit is it is negotiable instrument, means that the depositor after buying the instrument can sell to another person again. The risk is this instrument is not guaranteed by Badan Insurance Deposits Malaysia (PDIM), and the second risk is this instrument protected by insurance back upper maturity only. If the customer sold the instrument before maturity, the customer will lose some deposit amount. The next one is pricing mechanism. The minimum nominal volume of the instrument certificate is 100,000 ringgit issued at 50,000 ringgit per certificate, up to 1 million per certificate. Next one is how is the instrument traded. This instrument can insure under 4 bond categories, which are short-term, second is long-term, third is zero coupon, and the last one is floating rate. For the short-term, maturity period is less than 1 year and the minimum volume is 100,000 ringgit while maximum volume up to 1 million. And for the long-term, the maturity period is more than 1 year and maximum up to 10 years. For the zero coupon, the maturity period is at least 1 month and maximum up to 10 years. And for the floating rate, the maturity period is at least 1 year and maximum up to 10 years. The minimum volume and the maximum volume for the long-term zero coupon and the floating rate is the same, which are the minimum volume is 100,000 ringgit while maximum volume up to 10 million. Is there any secondary market? Yes, this instrument can trade in secondary market based on outright sale and purchase. This will get the seller to transfer the ownership of negotiable instrument of deposit to the buyer without the right to recourse except the insurer. The insurer purchase and redeem its own negotiable instrument of deposit before the expiration date. This will result in the negotiable instrument of deposit liquidation in the premature. Other than that, according to the repurchase agreement, the first seller and the first buyer separately promise to repurchase and sell back the negotiable instrument of deposit at the agreed price and the particular future date. Where and how can you accept to this instrument? The customer can apply this instrument over the counter of the bank. For commercial bank like AfriBank Berhad, MBank Berhad, Citibank Berhad, and Hong Leong Bank Berhad. And for the merchant bank like Public Merchant Bank Berhad, Utama Merchant Bank Berhad, and the M Merchant Bank Berhad, and so on. This diagram is about the process of negotiable instrument deposit. The insurer bank issues deposit certificate to a depositor which certifies that a certain amount of money has been deposited at a particular rate with the bank and for a certain maturity period. If the same depositor keeps the instrument stay maturity, the depositor can redeem the certificate with the insured bank. Besides, the depositor can sell the deposit certificate to investor and the investor can keep it or resell again. If the investor keep the deposit certificate till maturity, the insurer will directly pay principal plus the last interest to the investor and the investor need to give back the negotiable instrument of deposit to the insured bank. In addition, its investors resell the deposit certificate to another bank and another bank can keep it or else resell again. If the another keep the deposit certificate at maturity date, The insured bank will pay the principal plus last interest to another bank, and at the same time, another bank needs to give back the negotiable instrument of deposit to the insured bank. Lastly, if the another bank sells the deposit certificate to the another investor at the maturity, another investor can redeem the certificate from the insured bank, and the insured bank will pay the principal plus the last interest twice to another investor. Next one is, are there any office guidelines regulating this instrument? Yes, this is because negotiable instrument of deposit is a product issued by Bank Negara Malaysia. The guideline on negotiable instrument of deposit on May 2002 have revised by Bank Negara Malaysia, and the new guideline is published on 15 June 2006. And the instrument is also provided by commercial bank and merchant bank, and is authorized under the 1989 Banking Finance Institution Act. The guidelines on negotiable instrument of deposits are applicable to foreign currency and Malaysian ringgit. The last one is, the objective of preparing the negotiable instrument of deposit guideline is to provide a standardized set of terms and condition procedure for regulating the issue and trading of negotiable instrument of deposit on the market in the Malaysia. Who are the regulating agencies? The regulating agency for this instrument is Bank Negara Malaysia, Commercial Bank, Merchant Bank, and Banking Finance Institution Act 1989.
Good afternoon to sir and my friends. I'm Gayatri Siraju, metric number 259469. Today I would like to present about Sale and Buyback Agreement SBBA Malaysia. SBBA Malaysia is an Islamic financial instrument, and this financial instrument is almost same as the conventional repurchase agreement repo. But this financial instrument SBBA must comply with the Sharia regulation. SBBA is two parties, whereby one party will act as a seller to the sale at a certain Islamic security, while another party acts as a buyer who will buy the security at a specific future date and at an agreed price from the seller. The purpose of its creation is, SBBA Malaysia is an Islamic monetary instrument offered to improve the liquidity in the Islamic interbank money market. The quick improvement of Islamic financial framework has required the requirement to make an extra instrument for IIM to address the hiring needs of necessity by Islamic financial members. Then how it is created? SBBA exchange include the complement advance, which are commitment by the party with sale Islamic protections, and the other party with buy Islamic protection. Both parties are guaranteed top from the result at a specific future date. Result from of the responsibility is the implement of Islamic protections under SBBA. The SBBA is most likely to repurchase agreement has been modified as follow the Sharia standard. Then SBBA buyer pay cash to the seller. The second is SBBA seller deliver SBBA asset, and the third is on maturity seller buyers pay cash and plus the SBBA profit. And the last is SBBA buyer return SBBA asset to the seller. Who are the parties involved? Seller and buyback contract involve a contract of sale between two parties. Original seller to buy the asset back, and the buyer decide to sell the asset to the original buyer. Rights of each party. Okay, the seller offer the instrument to the purchaser for cash situations purpose, and the purchaser get them to venture reason. The base of SBBA transaction will be exchange depend on the cost price. Ownership transfer its owner by Islamic security sold under SBBA and transfer from the seller to the buyer. Transaction party can take under SBBA transaction through the cash merchandise or through the direct transaction. Both parties shall exchange SBBA term and agreed on the type of security. the SBBA price, tender, or the settlement date, among the others. There are two agreements, first agreement and second agreement. First agreement, SBBA seller Islamic security directly to the SBBA buyer at the agreed price and date of settlement. The second is the buyer of SBBA promised to sell the Islamic security back to the SBBA seller, who will promise to buy the instrument back and at the agreed price and the future settlement date. The promise shall be based on the undertaking both the SBBA buyer and the SBBA seller to sell and buy back the instrument at SBBA maturity date respective. The responsibility or obligations of both parties. Each parties must do everything reasonable required by the other party to reserve any action taken to the agreement. This agreement will be eligible agreement entered in the preface to this agreed will be based on the otherwise agreed by the parties. Be of the force or effect without the breaches to other right any party have against the other in the respective of the such failure of branch. And the risk to each party have credit evaluations, means member of SBBA might be visible to counterparty hazard in the case of deferred counterparty. MBBA SBBA will perform structures credit assets on the imposed credit cap on their counterparties before performing repo exchange. And the liquidity risk is that counterparty cannot settle a commitment for the full worth when there is expected or due, when however would have an open option to choose some liquidation date from there on. A couple of dealers deal with their liquidity by selling the turnover of the contentious security not more than 3 days. And the last is a return and benefit to each party. Legal certificate transaction. SBBA is done on the base of the transaction transfer of the own. Under this methodology, asset and the protection are moved against a commitment on the transfer to reserve the assets of the potential protections on the development of the agreement. Using SBBA may run the risk that if the document supporting transaction were not careful draft and the counter will be recharacterized the transaction as a collateral loan and standard legal agreement master of agreement has been developed addressed to the different legal aspect of SBBA and clarify the participants' role, responsibility, and the legal framework in the particular jurisdictions. And the second is the master agreement. A master agreement is a document defining the conditions that apply to all transactions between parties or a given subset of transactions, include remedies in the event of the differed from the counterpart.
Hello, my name is Udireka, daughter of Sagar, metric number 256056. I will continue about the SBBA Malaysia. Number 1. What is the pricing mechanism? The minimum value of SBBA transaction is at least 50,000 ringgit. Besides, the attributes of SBBA where the transaction must have a fixed maturity and the period should be more than 1 year. Next, how is the instrument traded? SBBA Malaysia is traded based on price. A party who is known as SBBA seller will sell the Islamic securities at an agreed price to other party who is known as SBBA buyer, and subsequently the SBBA buyer and the SBBA seller will enter into another agreement whereby the former promises to sell, the latter to buy back the securities on a specified future date at an agreed price. The difference between the selling price and future buying represent the return to the investor. The reason for the seller to sell the securities to the buyer is for cash to funding purposes, while the buyer buys them for the investment purposes. Next, is there any secondary market? Yes, there is secondary market where the SBBA buyer promises to sell back the Islamic securities to the SBBA seller, whom shall also promise to buy back the instrument at an agreed price and at a future settlement date. Where and how can you have access to this instrument? For Islamic banks to be competitive in the industry, SBBA is found to be instrumental in the liquidity management. Customers can apply for this product over the counter at any banks that offer for Islamic products and services such as Mbank Islamic and Maybank Islamic. Next, how does this instrument used in a bank treasury operation? As you can see from the diagram above, between the SBBA seller and SBBA buyer, number 1, the SBBA buyer pays cash to the seller. Number 2, SBBA seller delivers the SBBA asset to the SBBA buyer. And then, on maturity, the SBBA seller sells pay cash and SBBA profit to the SBBA buyer. And then, SBBA buyer returns SBBA asset to the seller. For the explanation, based on diagram 2, the process of SBBA transaction is the SBBA buyer pays cash to the seller for investment purposes. Then, after SBBA seller receives the cash, the seller will deliver SBBA asset to the buyer for cash funding purposes. In addition, the buyer undertakes to resell back the SBBA asset to the seller at a specified price on a specified future date agreed by both parties, who is SBBA seller and the SBBA buyer. On maturity, the seller will pay cash and profit agreed by both parties and buyer should return back the SBBA asset to the seller. And the next one is, are there any official guidelines regulating this instrument? Yes, there are official guidelines regulating to SBBA. The guidelines note on SBBA is effective from 15 August 2002. The objective of this guideline is to assist the market participant in SBBA transactions through best practices. Last but not least, who are the regulating agencies? Number 1, the regulating agencies for this instrument is Bank Negara Malaysia. Number 2, SBBA is keen to the repurchase agreement, repo, and has been modified to comply with Sharia principles. In addition, the National Sharia Council for Islamic Banking and Takaful of Bank Negara Malaysia (BNM) has affirmed the SBBA financial instrument. That's all from me. Thank you.
In conclusion, T-bill for Canada and negotiable instrument of deposit for Malaysia is a conventional finance instrument, while sell and buyback agreement for Malaysia is an Islamic finance instrument. The main difference between these two types of finance instrument is Islamic finance instrument have to comply with Sharia compliance but not for conventional finance instrument. Every type of instrument have their own respective feature and use in order to meet certain needs whether for individual or business use. With proper instrument, we above to utilize the finance instrument to the utmost in order to fulfill our need. Our recommendation for the finance instrument is the customer should seek advice from the banker when they want to apply for finance instrument or for investing. For example, if the customer has surplus fund and they are looking for investing opportunity using the surplus fund, they can refer to the banker or what type of finance instrument can they invite in.